ever since the NFP, we are now starting the price at 50 bips. So 25 is guaranteed at this point. I definitely feel like the dovish dissenters in July were emboldened. Every data point's looking weak. Weak.
So we just got a horrific jobs report. We're next week about to probably get an accelerating inflation report. We got tariff legality mania coming down the pipe. We got Lisa Cook fraud Fed mania coming down the pipe. Trump's probably going to make 10 more Powell firing threats. Just doesn't seem like a place to really stick your neck out to me, other than the only asset that front runs what the solution is here.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you then. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another roundup edition of Forward Guidance. And this week we have another little switch up. Last week Quinn was out, you're out traveling. This week you're back. Tyler's out again. Tyler's, along with his 3 or 4 kids. I don't even know how many kids he has, but with all his kids, he's back to school as well. Got his new job. He's working at Muddy Water. So congrats to Tyler. He's taken this week off, and we joked. I was like, man, I'll say that you're going to take this week off, but you better not leave me fucking hanging again and ditching us again. And he has on good authority saying that he is only just taking this week off to get settled in. So he will be in next week. If that doesn't happen, we can hold him accountable, but it's looking good. So Tyler, congrats. But for this week, it's you and me, Quinn. What's up, man?
Hey, man. Good. Fun week. Fun start to back to school month. Yeah, Tyler, we got a 2-strike policy here on Forward Guidance. If Tyler ditches us again, he's out.
Exactly. All right, let's get into some things here. Before we get started, a little shout out for our next big conference coming up, Digital Asset Summit in London, 2025. October 13th to 15th. It's going to be a lot of fun. We're going to be there. We're going to be chopping it up. The last DAS was incredible. It really fired me up in terms of just how excited the institutional landscape is about digital assets right now. It's crazy how different it is from the retail degenerate side of things like crypto Twitter that just feels cynical and depressed all the time. And then you go to these conferences where everybody's suited up and you're talking to, the head of crypto, BlackRock or whatever, and they're just so fired up on what's going on right now. So it's really interesting. Should be a lot of fun. So get your tickets. Going to be a good time. Talk about macro case for digital assets, ETFs, allocators' perspectives, all kinds of things. Should be good. So get your tickets.
I love how the conferences that Blockworks does are turning into the worlds colliding, which, is us from the macro side have always been super excited about where the crypto stuff meets traditional, but it's finally happening. And you're seeing almost the biggest stories now in crypto are almost by definition things that touch traditional side in a big way, or traditional players entering. And that obviously is a trend that's going to continue. So it's cool to see how much even non-crypto stuff is seeping into these conferences and things maturing.
Yeah, 100%. It feels good sitting where we're at, which has always been at this cross current of TriFi macro and crypto, and to see it all come together. So yeah, super exciting. All right, shills aside, let's get into things. Big week for labor data. Lots going on. So I'm not fully done the shills. I got one more shill to do. Every week I write a newsletter. We have this forward guidance newsletter. It goes out every day. Every Thursday I write for it. So yesterday I wrote a little preamble on all the labor market data that we had so far heading into the NFP that we got today, which we'll get into in a second. But just want to level set on some of the data here because I think there's a couple interesting things to go through. So we got the JOLTS data this week. always important to remember that this is quite a lagged data point in terms of the economic data that we get. So this is as far back as July, which, much like that last jobs report, was quite weak. So we saw job openings surprise at the downside at 7.18 million, below the expected 7.4. Not great. I think a really nice way to characterize this is just looking at the jobs and workers gap. So for the first time, basically since COVID, we've seen that there's more unemployed people than jobs available. And this isn't an outright sign of recession. Like you can see in the 2010s, we were negative the entire time, basically. But it is just important to show just how much more slack there is in the labor market right now, just how much it has been cooling. And also how that moves into the beverage curve as well, where you can see that the job vacancy ratio, like we're right on the edge of where, if it gets worse, the unemployment rate will accelerate. So there's that going on. Then we had the ADP report, which has increased importance now ever since the BLS commissioner got fired. Now we have this private enterprise that hasn't had very good predictive power of what the NFP is going to do, although it did actually this week, which we'll get into in a second, but they both surprised at the downside. But generally speaking, it was quite weak, and they've both been tracking each other pretty nicely. So there's that. And then finally, there's the Challenger survey of layoffs, which was also quite weak. So this was a really interesting point from an economist, Parker Ross, big fan of. But he was saying that last August is a tough benchmark when layoffs were already 81% above the pre-COVID norm. So the fact that we're up 13% year over year from that elevated level means we're now 105% above the pre-COVID norm for August, up from 98% in July. So regardless, and we'll get into this in a second to the NFP, but every data point's looking weak. So doves on the Fed, Governor Waller, I'm sure he's feeling vindicated right now. What's your thoughts, Quinn?
None of this is surprising. I mean, it's like this has been the slowest moving train wreck you can imagine. If you just pull up the unemployment monthly numbers over 3 years, it's a straight line down. I mean, but just very gradual. So it's not surprising. And then what muddies the water, not to pun intend on
shout out
Tyler's
Tyler.
new gig, but yeah, shout out Tyler, is the immigration thing, which is, takes down of both supply and demand. So, normally I think why there's so much confusion for people, just to clarify that, is like normally in a recession or when jobs data starts rolling, you don't have, Six Sigma magnitude events in your population growth. And so when the jobs number starts rolling, you say, wow, demand for labor is really falling because supply is generally the same. Well, here we're having like a once in a generation, reduction in population growth. Well, twice in a generation, because we had the opposite post-COVID, open border. And then that's making it a harder picture to paint as to how weak the economy actually is. And so the jobs numbers, like if you look at NFP since really immigration clamped down, let's just say March, April, it's very difficult to see how we even break above 50 to 100K jobs in a month. You just don't have the supply in this environment. So, and obviously demand's pulling back. It's a weird one because so many of these things are hitting the consumer, right? Wages are stalling out, no one's hiring, but also not really many layoffs and firing, but people aren't getting wage gains. AI is taking jobs. We have the highest youth unemployment rate since, Great Recession. We have the worst new college graduate job landing rate in like 3 or 4 decades. So yeah, it's hitting the consumer. So corporates are still, I guess, okay. Earnings have been okay. They've been good. I think now it's harder to look through this maybe for the market. Like what does 25 or 50 bips do? Does that an extra 25 bips create another 50K jobs per month? I don't know. I don't think so.
Yeah, you need some more. I saw a tweet from Bob Elliott mentioning that. It's just like for the way the economy is structured nowadays, like you need a powerful fiscal impulse, or you need the Fed to be like buying debt like crazy, stuff like that. Like the Fed funds just doesn't really move the market as much as it used to. Yeah. All right. Let's paint a picture here and get a bit more specific on this NFP print, because man, it was a surprise to the downside. Median estimate was 75,000, came in at 22,000, and I think that really just hits the nail on the head of what you're talking about there, Quinn, about this. When supply is coming down and demand coming down, the break-even rate is much lower. So yes, this was much weaker than expected. And what was also happening is, well, let's just get into the specific numbers for a second to catch everybody up. But Unemployment rate rose to 4.3% from 4.2. I think unrounded, it basically went from something like 4.27 to 4.34, I believe. I could be wrong. But anyway, roughly around there. Again, US added 22,000 jobs, well below an upwardly revised 79K in July and forecast of 75K. And the big one is that June was revised down and is now negative. It's pretty crazy to think about. Just a couple prints ago when we got that initial print, it was at like 141,000. And now we're looking at a negative jobs print. So that really just underscores this really weird situation at hand. Looking at some of the main breakdowns here, all the job growth is still just in education and health services. It's really crazy. Like, so this is just looking at that revision just to say it. First negative print since COVID. So that's definitely a signal. And the fact that it just came from such a high initial print number. But if you just look at this one, this is really interesting to me. So circling back on that previous chart there, in terms of where all this job growth is even coming from that exists, and it's all private education and health services. If you look at the rest of the economy right now, it's outright negative. So any sort of meaningful positive dynamic right now is either government or this whole healthcare service fiasco thing. So pretty weak. Did it surprise you, Quinn? What was your read on the NFP when you first got it? Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I mean, my first read was who's getting fired now? Are we just doing away with all the numbers completely after this one? But yeah, the S&P 493 has been in a recession for longer than just those 2 months that non-government healthcare jobs have been negative. Like, it's the two-speed economy that hasn't corrected because policymakers have prolonged the liquidity to support markets. So it's going to be really interesting, because what I think that maybe gets lost in I called it on a pod this week, that the Trump bum rush of the Fed, where is the race against the clock here, where I think, okay, just even this week, there's another Fed paper talking about where they think neutral is. And I think they it's like between, let's just say 3.25, let's say 3 and 4. So, another 1, 2, 3 cuts from here. Okay. What's that do for the economy? I don't know if it's much, but really what Trump needs here is not just cuts accelerated, but he needs a full Fed on his side for preemptive, like, balance sheet measures. I think pressure in the markets here could culminate or be added by some of the funding things and reserves starting to get hit with the supply issuance. So I wouldn't be surprised if QT ends in the next 1 or 2 Fed meetings. But again, we're at $5 billion per month on treasuries and 20 on mortgages. Trump, you're going to see this pick up his attacks on the Fed, because he needs friends in there to be doing more heavy lifting than just rate cuts.
Man, can you imagine being the new BLS commissioner and you come in and then you have to tell the Trump administration that you have to make July negative?
Yeah.
Well, that's enough.
I love these lines that
last night and said,
yeah, they're trying to walk these balancing lines of the like. If you go, every other Trump tweet is like, the economy is booming like never before, and then he's like, cut rates. There's just so many things that don't add up.
We need to cut rates because the economy is weak. We just got to cut rates, man. Okay, so let's get into what that means for September. So going into the NFP, I believe we are at about 95% odds for a September 25 bips cut. And ever since the NFP, we are now starting to price in 50 bips. We're at 40% odds of 50, 86%. So 25 is guaranteed at this point. I definitely feel like the dovish dissenters in July were emboldened. So props to them. At the time, I thought it was a bit silly, but I think it's coming to light now that the labor market definitely needs some sort of oomph. Whether Fed funds is the right medicine for that situation is another story. I think we just kind of characterize why it might not be. But the fact of the matter is, based on the traditional framework, here's where we're at. So we got cuts coming. Where do we go from here? Do you think 50 might happen?
I don't, because I think inflation next week's going to be a problem. But because I think inflation's going to show a higher month over month number, and but the market might make them. I mean, maybe the market pukes into the Fed meeting from here. I don't know too much. It'd be a huge about face to go from, Powell questioning the need for September to 50, but they did it last year. However, they did it last year with a lot more time in advance. They were signaling it for a few weeks. So it was interesting to me, though, that we went to this even 10% chance of 50 today. So I wouldn't rule it out, because if you remember last year, they clearly whispered it to the market well in advance, because just randomly, with no Fed speak during the blackout window, it just started creeping up from 25, and then all of a sudden we're at like 55% of 50, and we know they won't surprise the market, at least to the downside. So yeah, we'll see. Well, I think it depends what stocks do. If stocks were down 10% by the meeting, yeah, they'd probably go 50. If stocks are at, rubbing up against all-time highs, probably not.
Yeah, I agree. It all comes down to the CPI print, and that's what's so hard right now. I definitely do still feel like inflation has more upside from here, and so it just becomes this stagflationary light mix situation, or it's like, which side do they prioritize? And I do think at this juncture, it is more warranted to prioritize the labor, at least for a 25 cut. But to go to 50, like, you need CPI to be playing ball here. If it comes in hot, there's no chance.
I think that's what people were the stagflationists, because I think we're both in that camp. I'm probably more in that camp even than you. I mean, oil's fine, so maybe it's not that urgent right now. But I think where people, poo-poo the idea too soon is like, stagflation doesn't require 10% inflation. Stagflation can also be 3 to 4% inflation with 0 to 1.5% growth, and you're still in an environment where the Fed can't do anything that's helpful. Like, okay, what do? They stimulate, and then that stimulus goes straight into commodities and more inflation. So it doesn't need to be like 70s war, oil embargo, crisis type to be characterized as stagflation. We're firmly in it.
Yeah, let's talk a bit about what gold's doing in light of this, because it's a really interesting one, because we've seen, it feels like the correlations for the past year at least has been that it's been this inflation upside hedge in terms of, okay, we're running it hot, the whole fiscal nothing stops this train thing, and that's been getting gold higher. And then when you look at the jobs report that we just got today, you would think that notion would have just got whacked in the head, and it sort of did. I mean, bonds are rallying like crazy today, but gold is still rallying like crazy today. And it's interesting to contrast that with this other side of the coin of gold, which is that if we're getting more negative real rates, that's going to be pretty positive for gold. And so it's really interesting to see the price action today, where equities sold off, bonds are rallying, crypto sold off, but gold is still in the mix there. It's up 1.5% today. What's your read on gold? I think we're both pretty bulled up on it.
My July and August letters to investors, when I kind of was, it was my only idea. I had a couple calls with, I was talking to some other investors last 2 months, and I was just like, I'm not buying, Ponzi treasury companies, and I'm not buying, like, it's just the only thing that made sense to me is gold. We're in inning 1 to 3 of this debasement playbook. We're nowhere near. QE hasn't even restarted. We're still in QT. I mean, we're so early in the debasement playbook, and Tyler gets crap for calling it Weimar America, but we're so early in this debasement playbook relative to maybe where like Bitcoiners and other people think we are. And so you had 4 or 5 months of consolidation. You had open interest, reduced, and we know China and the central banks around the world that are ditching their treasuries and also not buying new treasuries because the trade deficits that we're running are shrinking. So people are getting less dollars to recycle into U.S. assets. They like to buy the moving averages, and so I think it's cold up here. I mean, I see it running into November, December. I mean, there's going to be volatility along the way, but it's not a US centric thing either. This is a global problem. Everybody else is we have the highest real rates. I mean, there's some of them, Europe's at basically zero real. So, I mean, imagine if we just go down to zero real to match most of the world, right? I mean, that's another, what's gold do then?
Gold is such a good trade right now. When you think about it, it captures both tails. Your only risk, we can talk about this, is some sort of margin call situation where it just gets whacked. But otherwise, it's like, all right, if we ramp up the fiscal, it's gonna get that tailwind. All right, if we're ramping up the cuts and we're getting negative real rates, all right, that's gonna be the winner on that side too. It's only really just getting whacked by some sort of margin call situation is the downside, I think.
Yeah, you can hedge that with equity beta. I had this chart. Let me find it from kind of my weekend reading that was actually kind of surprising to me about gold ownership. Yeah, it said which of the following is from the BAML survey? Which of the following comes closest to your current gold position in your portfolio? 41%. This is traditional investors. This is from Bank of America hedge funds. 0% own gold. 41% own zero gold, 20% own 2% gold, 14% own 4% gold. You think about that, like this is a top performing asset for 3 years straight or 2 years straight, and no one owns it. I mean, everyone's chasing Ponzi left and right, shitcos. And I mean, obviously Bitcoin and crypto has done well and AI has done well, but this, I feel like, you're starting to see early signs of exuberance for sure. I mean, look at miners. Gold miners are ripping. I like gold a lot better than gold miners here, just because you remove that equity beta from it. But yeah, I think that's still way too low, because in a world where everybody's real rates of return are going to plummet and purchasing power protection is going to need a premium, and multiples for all equity indices globally are at range highs. I don't know what else you can long that makes sense. I mean, if we're going into a slowdown recession and the Fed's behind, I don't really want to buy energy commodities. I mean, so and if you sit in cash, the 2 years down to 3.4 and we're about to get a 3% inflation rate. I mean, you have to be in gold, I guess. I don't know. It's a shit environment.
It's just going to become a gold bug pod now, one of those. I got to get Peter Schiff on. I was listening to Jared Dillian and Tony Greer's pod where they were talking about the gold breakout, and they're saying that they're both pretty fire. I think Jared was calling for like 5,000 on gold by year end, which is pretty nice one for sure. But they're also saying they started to see some of those, when you start to see the sentiment shift, like they're saying there's like memes going around of Peter Schiff dressed in gold with like gold grills and stuff right now. And you would think, oh my God, what a tough signal. But it's like, okay, but after 6 months of consolidation, that's just the core gold bugs getting a little excited, but nobody's talking about it in the mainstream. And to your point, the institutional side does not own gold right now. Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
No, I mean, so we just got a horrific jobs report. We're next week about to probably get an accelerating inflation report. We got tariff legality mania coming down the pipe. We got Lisa Cook, fraud Fed mania coming down the pipe. Trump's probably going to make 10 more Powell firing threats. Like, we had a clown show, Senate hearing this week. I mean, I just want to buy more of it. Like, maybe, and, bonds looked good this week too. I wouldn't buy them here, but it's a weird little period here. I think it reminds me a lot of some of the stuff last summer where you got this growth scare. And one thing I was looking at today was the yen was looking quite leaky, or the dollar yen. And that was, if you remember last July, we had the bad jobs report that sort of set off things on August 1st. So, I mean, positioning is not the same, but, It's interesting.
I think to that point about the tariff legality thing, more and more I think about it, this is going to be the most important theme for the next 12 months is whether that gets overruled or not. And there's a great tweet from shout out Ben Kisimchuk. I actually interviewed him on the pod this week, just came out a few days ago. Really, really good interview. Saw a lot of good words about it. But he lays this out. Trump has asked the Supreme Court to expedite its reviews of tariffs, aiming for a decision by November, well ahead of the original spring 2026 timeline. By November, the total tariffs collected are projected to reach approximately $170 billion. This figure now represents a potential pre-year-end stimulus to corporations if the tariffs are struck down and refunded in November. So really important to discount this because I think a lot of the gross scare situation, the reason I'm somewhat entertained of these ideas of gross scares and even recession is just a simple fact of we're raking in annualized like $450 billion in tariffs. That's getting passed through at 80 to 90% to consumers. Okay, so that's a tax rate. That is $450 billion coming out of purchasing power and going to get extinguished at the government in terms of money available. So pretty clear negative headwinds. And then if the Supreme Court reverses that, they have to refund all of that. That is just, that would be the biggest 180 I can think of, to go from the situation where we just had the biggest tax rate hike in history, or like at least in many decades, to this complete reversal of just mega stimmy refund machine. Man, how do you even manage that possibility? That is just an insane reversal.
So one, okay, I hear his point, but what are you going to buy the NASDAQ at 25 times earnings because corporates just got 170 billion back in their coffers? Like, no. So maybe if we're 10 or 20% lower in stock multiples by then, this makes sense. But the other component here is it's not free lunch. The 170 billion would then have to be turned around and sucked out of the market from the treasury issuance, which might be even worse because we're talking about reserve scarcity, no RRP, and shaky bond auctions. So, I mean, it would have to be accompanied by. So I guess that's the bullish part. If they wanted to rip 170 billion out of the markets right now to fund bigger government deficit, that would have to be accompanied with Fed support. There's no demand for that, or it'd have to be bills, more ATI. But so it'd have to. But it's just too. It's such Trump's tone and body language around tariffs. That's why he's been saying, GFC, because the deficits would blow out and you'd have inflation. I just don't think they're going to back down that easily. They already have all the trade deals struck too, and it's trade deals with friends. So they're going to say to Japan, "Hey, Japan, you're going to really not pay this?" And Japan's going to say like, "No, we will." And it's only the bad actors who they don't have trade deals with anyways, Japan or China, India, Russia, or all these guys who would actually say, "Fuck you, I'm not paying it." But it's just too it's too far out. Plus, uncertain to really speculate on. I think for the markets, they'll react when they see it.
Yeah, there's also a million different other ways they can pursue tariffs. Like this is specific to the IEEPA, and I don't know. We talked about it a couple months on the show, and this all started to come out. But there's a lot of different mechanisms they can go through to put on tariffs. So, I don't think it's realistic to just think this whole thing just gets reversed and then we never talk about it again. That seems unlikely to me.
Yeah, I agree.
We've hinted at it a couple times, but let's get into the monetary plumbing situation. So, as of right now, we have the reverse repo down to 21 billion from just a couple of years ago is at 2.5 trillion. And so the question of the era right now is, okay, we need to refill the TGA to 850 billion. So right now we're at 690 as of September 3rd. The bottom chart is lagged. For whatever reason, Fred Data does not like that. It just updates every week. Whereas if you go to the daily treasury statement, you can see it every day updated, the TGA. So, okay, we're at 690 right now. We have some very, very large bill of treasury auctions happening at the moment. September is a very heavy month for it. They're trying to get back to 850 billion. At the same time that buffer, the RRP, is basically at zero. I think most sophisticated analysis I've seen is that it's unlikely to go totally to zero, but consider 20 is basically de facto zero at this point. So, okay, here's where we are. So we need to issue that much amount of bills and refill the TGA without getting any sort of scares. And so This is an interesting site I found this week that shows analyzing. This is way too wonkish monetary plumbing stuff that I only really have a solid understanding of like 50% of it. But smart folks that I know that actually work on stir desks have validated this for me. And one of the best ways to actually analyze and look into the sensitivity of these bill issuances to refill the TGA versus bank reserves available is this tri-party general. Actually, I'm not even going to try, but TGCR is one of those repo rates in the Fed monetary plumbing network. And you can see how that gets regressed and affected by TGA rebuild. And what you can see is basically, to put that all into English, is blue chart up means funding constraints. And you can see what happened the last time that we saw this major scare in September 2019 is when you saw that blow out higher. You can see right now on the far right that we're starting to tick up higher, not at outright, alarm bell levels yet, but it is concerning. And so we have a bit more ways to go. Quinn, you've been all over this. I'm curious how you're thinking about all this liquidity situation right now. It feels like we're on the precipice, but it's not quite bad yet. That's my read.
The bulk of the bad TGA refill supply is through, because the last big step function increase is from tax day and on September 15th, which you're going to see like 100 to 150 billion come in. The bigger problem that's more sustaining is the RRP not buffering reserves. And if you want to get wonky, you look at the charts, and RRP stopped going down earlier this year, and they were drawing down the TGA, and you still had the liquidity event in Feb to April. And again, like Fed cuts really do much here? It's sort of a balance sheet thing as well. So between the growth data and this, I just don't see the upside in liquidity with just an extra one or two cuts from the Fed. So that's where I'm shaking out when you put them together. I just don't see where, like, let's say, liftoff potential for risky assets comes from. But the Fed's going to have to do something here. I mean, it's a classic, like, they're not going to come out and say, we're shit scared about liquidity, but it's going to come way quicker than, because when stocks are floating along all-time highs, everything looks good, right? No one cares. But then the second you get some turmoil or turbulence, and that's when the cracks start to seize, the tide goes out and who's wearing shorts. So they're gonna have, probably by year end, be doing some more monkey business with the balance sheet, is my view.
I think so too. This is the sequence I tweeted out the other day, looking at what I think could happen from here on out. And so the first step is allowing SOFR to creep higher to the upper band of the Fed fund range, so near interest and reserve balances. The reason reverse repo had so much balance in it is because the Fed funds was at the lower part of the band. So first off, you need that SOFR rate or EFFR to get to the upper bound, and then get to the upper bound, and then see continuing issues that, okay, we are up there, and now there's these funding constraints. We're starting to see regular and daily uptake in the standing repo facility. Now, the reason why I don't think we're going to see like a September 2019 repeat, which you saw in the previous chart, is because this standing repo facility exists now. It did not exist back then. So you can just have people go into that facility and buy. So you won't see those huge surprise upsides of SOFR breaking out above the upper range of the Fed funds range. So I think you'll see that once you see that steady uptake in standing repo facility. If you want to look at one gauge to know where we're at in the sequence, is keep an eye on that SRF and see if there's regular uptake. There is not regular uptake right now. There is some around quarter end and window dressing situations, but right now that's about it. Once that happens, I agree. I think quantitative tightening will end in earnest. Don't know if they'll fully stop unwinding mortgage-backed securities. They've said they want those off their books, so maybe they keep that. But then, the $5 billion of Treasury QT that they're doing, which is almost meaningless, sure, they'll axe that. But then you get to this level of, ample reserves regime or abundant reserves, where you will see that we when we have bank reserves get to, I think, 7% of GDP levels, that's where you start to get those alarm bells start swinging. So that's where I think we will start to see the central bank balance sheet start to increase in growth. And I'm predicting now everybody's going to start calling that QE. They're going to say QE's back, or they're doing stealth QE or doing hidden QE. And I don't know, maybe it's just this stupid semantic stuff, but to me, that's not QE. QE is buying the long end. They're going to be buying bills and swapping it for bank reserves. So the duration change is minimal. It's more of a liquidity thing. So I think that's when you'll start to see the central bank balance sheets start to increase, reserves to increase again, and move in line with GDP. But that's not quite QE in the way of it, going out into the market and buying duration. Do you agree with that sequence, Quinn, or what do you think?
I think that's right. I mean, the difference, I guess I would say, is that that reserves to GDP ratio, we're still quite a bit above that. Like, I think a healthy number of percentage points. Maybe we're like 9 to 11 or something. So there's actually still a lot of room there. I just think that where the markets are at, and I think they're more fragile probably than they've been in many, many years, probably would show signs of stress prior to those prior levels. But yeah, I agree. I mean, them stepping in for the front end, I mean, it's helpful on the margin. It gets you out of a liquidity seize up event. So if assets are down in the basement from a puke, then a liquidation, it helps. But you can just think of it as making sure the machine works, not, supercharging, booster powering the machine like QE. And there's not really like a bid for these high, long tail risk assets if the machine isn't going at full speed, if it's just barely working. So it feels there is definitely some corollaries to late 2019 here, where the economy was like sort of okay, or at least people thought, and stocks still drifted higher, but like longer tail liquidity driven assets underperformed pretty big because you just had stocks by the buyback and earnings growth staying elevated, but no impulse of liquidity or otherwise. So we'll see, but it's definitely going to become more of a topic. I expect, I would not be surprised at all if it's talked about at September. Maybe not the presser, but probably something in the minutes. And then, because if they want to do it in October or December, they probably start, whispering it to the market.
What do you think of the dollar in terms of all of this? We haven't really talked about currencies. I'll just say I don't have a good read. Like, it feels like sentiment is still dollar bear, but we've just been flatlined for the past few months. What's your read there?
I certainly wouldn't buy the dollar. The recent strength, some was attributed to Europe's problems or global issues. So just more of a safety bid. But I think, dude, the candles on it, like on the 3-day and weekly, it just gets sold into any time it shows any amount of strength. I think my biggest takeaway from it is it's notable to me that despite bond yields basically imploding the last number of weeks as the 2-year, particularly on the front end, have just come down. It's been notable to me that the dollar has stopped. And so that it smells a little growth scary type of action, maybe some safety vibes there. But then it never gets too strong because people just dump it knowing that Fed takeover is within 12 months. So I wouldn't touch it. I think it's a good barometer. Like if we break down, I don't see if the dollar busts this key like 96 level or whatever, I don't see how commodities don't go roaring. But at the same time, the dollar's still kind of just holding the same area, even though now we're talking like 3 to 4 cuts the next 4 meetings. This is why I kind of come to the conclusion that Trump needs the big guns. He needs more than just rate cuts from the Fed, because we got the rate cuts priced in right now and the dollar's not moving. And you need the dollar down here. Stocks have had a negative correlation. Like, you need the dollar down, and the rate cuts are priced in. And so if the dollar's holding in, like, I don't know what event brings it, but it's just kind of like no-go zone for me. I'd rather just I think everyone's just ditching everything for gold, I guess.
That just feels like our main takeaway here. Just we're becoming gold bugs at this point.
I mean, it's just like, you absolutely would be, I think, crazy to buy the indices here at these valuation levels where, Mag 7 make up 40% of the index and NVIDIA looks like it's going to absolutely puke. And then at the same time, like, it's just complete risk off gold, or it's complete risk on, shitcos and like liquidity assets. There's no in between. Like, yeah, I don't know. And I don't think it's a ladder right now. So
yeah. All right, man. Well, I think we can leave it there unless you have anything else you want to say. But yeah, I would just characterize it as labor market's weaker than I definitely thought. And rethinking a few priors. I had this note about how I felt like I was mentally stopped out in terms of where I think about the labor market in terms of its weakness. So reassessing some things there. Yeah, if we're going to go into a bigger growth scare than I anticipated, you don't really want to own risk. But I do really like the idea of owning gold in that situation because of that negative real rates dynamic. You just got to discount some sort of hedge or whatever against a margin call situation where everything gets whacked, including gold. But aside from that, it feels pretty good to me. That sound about right?
Yeah, I think my message, like, to our investors has just been September. Everybody's bickering about is seasonality real? Like, yes or no? Is it going to follow the historical trend? Yes or no? Are we going to have the blow off top? And cash is a position too. I just, like, my message is like the hero trade to the upside is not going to be in September. It might come, we might get it. Everyone might be right, but it's not going to come in September. If it does, it's later, and there's other intricacies involved. So I think, we're on the 5th. We got a lot coming. We got a CPI print. We got a Fed meeting. We got, a pretty big quarterly options expiration. We have a corporate buyback blackout starting middle of the month. And you have the first month in 4+ maybe 5 years with no RRP and a huge treasury issuance burden that's barreling down the back end of the calendar. So just doesn't seem like a place to really stick your neck out to me, other than the only asset that front runs what the solution is here. So, but it'll be interesting.
Yeah, 100%. All right, man. Well, yeah, have a good weekend. We'll have Tyler back next week. Although I'm going to be out next week one last time. So
yeah,
you two can chop it up. Maybe we'll pull in that episode with Brandon. People seem to really like it. So yeah, maybe pull in somebody else. But then after that, the trio will be back in earnest. So we'll be locking in for the fall. Lock and fall is about to go down.
Absolutely. Yes, sir. Have a good weekend.
Have a good weekend. See ya.